You get the raise. Your salary finally crosses a number that used to sound rich. For about 2 weeks, you feel like you have won. Then the mortgage clears, the credit card payment posts, the insurance bill arrives, and your checking account looks almost exactly the way it did before. That is the part nobody puts in the promotion announcement. A higher salary can improve your life, obviously. More income gives you more choices, more room to save, and more ability to recover from mistakes. But a higher salary does not automatically fix a cost of living crisis. Because your financial life is not determined by the number at the top of your paycheck. It is determined by what survives. After taxes, after housing, after debt payments, after healthcare, after childcare, after transportation, and after your lifestyle quietly expands to match the new income. This is why someone earning $120,000 can feel more financially trapped than someone earning $70,000 did 10 years earlier. The number is larger. The margin may not be. Your margin is the amount left after your essential and recurring expenses are paid. That margin, not your salary, is what builds an emergency fund, finances retirement, absorbs a medical bill, and gives you the power to leave a bad job. And across the United States, that margin has become uncomfortable for a lot of households. Recent financial capability research reported that roughly 1 in 4 Americans said they were spending more than they earned, while nearly half said they had difficulty paying all their bills. Federal Reserve household surveys have also found that higher prices continue to hurt family finances. Even when a majority of adults describe themselves as doing okay. Both things can be true. You can be employed. You can earn more than you did before. You can look successful from the outside. And your financial system can still be one unexpected expense away from failure. So why does a raise sometimes disappear so quickly? The first reason is that your salary is quoted in gross dollars. But your life is paid for with net dollars. A $10 raise does not put $10 into your checking account. Federal income tax, payroll tax, state tax in many states, health insurance premiums, retirement contributions, and other deductions all take a share before you see it. That does not mean taxes are the villain. It means gross income is a bad measure of financial breathing room. Imagine that you receive a $12 annual raise. That sounds like an extra $10 a month. After deductions, perhaps the usable increase is closer to several $100s per month. Depending on your tax situation and benefits, then your rent renews. Your auto insurance rises. Groceries cost more. Your employer changes the health plan. Suddenly, the raise was not fake, but it was already assigned before it arrived. This is also where inflation becomes personal. Inflation is not simply a national percentage announced on television. It is the change in the price of the specific life you actually live. The official inflation rate might cool, but your personal cost of living can stay elevated if most of your budget goes toward categories that remain expensive. A household paying for childcare, rent, healthcare, and car insurance may experience a very different reality from a mortgage-free household with no young children. Your inflation rate has a zip code. It has a family size. It has a commute. It has a medical history. And unfortunately, it does not care that the national average is improving. The second reason a higher salary may not solve the problem is housing. Housing is usually the largest monthly expense in an American household, and it is difficult to adjust quickly. You can cancel a streaming service this afternoon. You cannot casually replace your apartment, refinance your mortgage, move your children to another school district, and shorten your commute by dinner. This makes housing a fixed cost trap. A fixed cost is an expense that repeats every month and is hard to reduce without a major life change. Once your fixed costs consume most of your take-home pay, even a strong salary can feel weak. Suppose your take-home income rises by $600 a month, but you use the promotion as the moment to move into a larger home. The new mortgage or rent costs $450 more. Utilities rise by $80. Insurance rises by $50. The raise is gone. You did not necessarily make an irrational choice. Maybe the larger home is closer to work. Maybe you need another bedroom. Maybe the school district is better. But the financial effect is the same. You converted flexible income into a permanent obligation. That trade can be worth it. It just should not be confused with becoming financially secure. The third reason is debt. Debt makes future income belong to the past. A credit card balance represents purchases you already made. An auto loan represents transportation you are already using. A student loan may represent education completed years ago. Each payment reaches into your current paycheck and removes money before you can make a new decision. This is why raises often feel strangely ineffective for heavily indebted households. The income rises, but the old obligations are still waiting, and when interest rates are high, revolving debt becomes especially destructive. Revolving debt is debt, such as a credit card balance, that can remain outstanding from month to month while interest is charged. If your card carries a high annual percentage rate, a meaningful part of your payment may go to interest rather than reducing the balance. You can earn more and still move backward if the interest on your debts, the growth in your fixed costs, and your new spending together rise faster than your take-home pay. That is not a motivation problem. It is arithmetic. The fourth reason is lifestyle inflation. Lifestyle inflation happens when spending rises as income rises. Not because every purchase is foolish, but because your definition of normal changes. The old apartment now feels too small. The reliable car now feels embarrassing. The basic vacation now feels inadequate. Restaurant delivery becomes a convenience rather than a treat. Subscriptions multiply because each one is only $15 or $20. Nothing looks catastrophic by itself. That is exactly why it works. Daniel Kahneman and other behavioral researchers helped explain a concept called adaptation. People become accustomed to improvements faster than they expect. The upgraded lifestyle feels exciting for a while. Then, it becomes the baseline. Once it becomes normal, losing it feels painful, so the raise creates a brief feeling of abundance, followed by a more expensive version of ordinary life. This does not mean you should never enjoy your money. A financial plan that treats every pleasure as a moral failure is not a plan. It is a punishment schedule. The issue is timing. When every new dollar is immediately used to upgrade your lifestyle, the raise cannot improve your resilience. You look richer. You do not become harder to break. The fifth reason is that high income can hide financial fragility. Banks, landlords, and lenders often evaluate what you can technically afford. They do not know what will let you sleep at night. A lender may approve a large mortgage because your income supports the payment under its formula. That formula may not fully reflect your desire to retire early, support aging parents, pay for private childcare, change careers, or survive a period of unemployment without panic. Approval is not the same as affordability. Affordability is not the same as comfort, and comfort is not the same as wealth. Wealth is what you own minus what you owe. Cash flow is the money moving in and out each month. A person can have high income, weak cash flow, and very little wealth at the same time. Consider two households. Household A earns. Household B earns $180, has a large mortgage, 2 finance vehicles, private school tuition, revolving card debt, and no emergency fund. Household B earns twice as much. Household A may be financially safer. This is why comparing salaries is often useless. You are comparing revenue without seeing expenses, debt, assets, taxes, or obligations. It is like judging a business only by sales and refusing to look at profit. So what should you monitor? Start with your savings rate. Your savings rate is the percentage of income that you consistently keep for future use. Rather than current spending, include retirement contributions, emergency savings, and long-term investments. But avoid counting money that will be spent next month. If your salary rises and your savings rate falls, your financial position may be getting weaker even while your lifestyle improves. Next, measure your fixed cost ratio. Add your essential recurring commitments: housing, minimum debt payments, insurance, childcare, basic transportation, and other expenses that are difficult to cancel. Compare that total with your take-home income. There is no magical percentage that works for everyone. A stable dual-income household may tolerate more fixed costs than a single-income household with irregular employment. The point is to know how much of your paycheck has already been promised. Then, track your emergency runway. Emergency runway is the number of months your available cash could cover essential expenses if income stopped. It is more useful than simply saying you have $10,000 saved, because $10,000 means something very different in rural Ohio than it does in San Francisco. Also, watch your debt interest, not only your debt balance. A large low-rate mortgage may be manageable. A smaller credit card balance at a very high rate may be a more urgent threat. The balance tells you how much you owe. The interest rate tells you how aggressively the debt is fighting back. Finally, calculate the raise capture rate. This is the percentage of a pay increase that improves your net worth rather than disappearing into higher spending. For example, suppose your take-home pay rises by $500 a month. You automatically direct $200 to retirement, $100 to an emergency fund, and $50 toward extra debt repayment. You have captured $350 of the raise, or 70%. For financial progress, the remaining $150 can improve your life now. That is not deprivation. That is assigning the raise a job before marketers, lenders, and convenience spending assign one for you. Of course, there are limits to this argument. Sometimes income really is the problem. You cannot budget your way out of rent that consumes half your paycheck. You cannot eliminate a child care bill with better discipline. You cannot positive think your way around a medical condition, a layoff, or a region where housing costs have detached from local wages. For many households, earning more is not optional. It is necessary. The warning is not that salary does not matter. The warning is that salary alone is incomplete. A higher income becomes powerful when the gap between income and obligations grows. It becomes less powerful when higher earnings are immediately matched by higher taxes, housing costs, debt, and expectations. There's also a difference between temporary pressure and structural pressure. A temporary expense, such as 1 year of major medical treatment, may disappear. A structural expense, such as an oversized mortgage or permanent lifestyle commitment, follows you every month. Before making a major upgrade after a raise, ask one question. Would I still want this payment if my income fell 20%? That question does not predict disaster. It reveals whether the purchase depends on everything going right. You should also ask what could make this warning incorrect. If wage growth consistently exceeds the rise in your personal expenses, if you avoid expensive debt, if housing costs remain controlled, and if you invest part of each raise, a higher salary can transform your financial future. That is the good scenario. The raise increases your savings rate. Your emergency runway grows. Debt becomes less important. Retirement contributions compound. And your lifestyle improves without consuming all of your flexibility. But that result usually requires a decision before the first larger paycheck arrives. Otherwise, the financial system around you is very efficient at absorbing additional income. The nicer apartment is ready. The more expensive car is pre-approved. The premium credit card has your name on it. And every company offering a monthly payment is prepared to explain why you deserve an upgrade. Maybe you do. But what you deserve most is margin. Margin lets you say no. Margin lets you survive. Margin lets you invest when markets are down instead of selling because you need cash. Margin turns income into freedom. So, when the next raise arrives, do not only ask how much more you earn, ask how much more you will keep. Because the number on your offer letter may impress other people. The money that survives the month is what changes your life. This content is for general educational purposes and is not personalized financial, tax, or legal advice.